Hi, I'm Max Keiser. This is the Keiser Report. You know, it's a financial war, and coded messages are being transmitted in the financial pages. Let's get into this, Stacy Herbert.
Yes, Max, we're talking about financial war all the time here on Keiser Report, and it made me think back to World War II. Under Nazi-occupied France, BBC London broadcast coded messages to the French resistance. Here are some of them, Max.
Grand-mère mange nos bonbons.
That was Grandma ate our bonbons, and now here's the blue horse walks on the horizon.
Le cheval bleu se promène sur l'horizon.
Right, this is fascinating. So these coded messages are being broadcast into occupied France as a way to communicate to the resistance. So it sounds like gobbledygook, it sounds like gibberish, but there's some meaning if you understand the code. And we see this now today, don't we, with this kind of financial semaphore looped into our day-to-day broadcast. Let's explain now exactly what's going on.
You start off with a headline like this, Max. IMF drawing up £517 billion package to save Italy, Spain, and the euro. Within moments, I see this tweet from BBC Business. Remember the Radio London of our modern financial era. IMF denies Italy loan discussions.
Right. So you have to really decode what's being broadcast from the centers of the financial war. Obviously, the UK is now hunkering down into the trenches, ready for warfare with the continent of Europe in this new global financial war. And you've got the same thing going on in continental Europe, and you've got the same thing going on around the world. So you have to decode these messages. So in this particular instance, it was just a straight denial of a coded message, but the underlying subtext is that there needs to be a blitzkrieg of cash coming quickly, or there's a Dunkirk in our immediate future.
Well, I think what it is that they send messages out like this.
Grand-mère mange nos bonbons.
But the people who need to know, the financial terrorists, know to read those articles and look for what is really going to happen. So the BBC article, for example, International Monetary Fund denies Italy loan talks. Now, if you read deep into the article, it says, over the weekend, the German newspaper Die Welt reported that a subset of Eurozone countries with the highest credit ratings, including France and Germany, may seek to issue debt jointly. However, the plans were also denied by the German government on Monday. They said there are no plans for AAA bonds or elite bonds, said the German finance ministry.
Right, but the subtext or the coded messages, we know that that's not the case. They do have a plan for an elite bond, or you might call it the master currency. It's a form of financial eugenics. The Überdebten from the Germans is coming, and they're communicating vis-a-vis the financial press. So people don't understand what's happening in the markets or finance or economics because they don't understand that it's all heavily coded to communicate amongst the various financial terror centers. Berlin, London, New York, Tokyo.
Exactly, Max. You call it financial eugenics. And this debt, the so-called elite bond, the so-called AAA bond by France and Germany, it actually has the same exact DNA of a Greek bond or an Italian bond or a Portuguese bond or a Spanish bond. It's riddled with banking fraud. It's riddled with too much debt. But they have the blue eyes in this case are the Fitch and Moody's and S&P rating at AAA.
Yes, the rating agencies are involved in financial eugenics. And they give the Uber currency coming out of Berlin the AAA blessing, as it were. But of course, they are exactly the same. Now, others have observed that this is setting Germany up for an interesting relationship with the rest of Europe, where they are, in fact, in the vendor financing scheme, where they are going to be looping loans into the peripheral countries and banking the spread, similar to what China has done with the U.S. for so many years. They just bilk the U.S. for hundreds of billions and trillions to this vendor financing scheme. Germany, being the other big exporter in the world, could do the same thing with the rest of the Eurozone by creating the Uber currency bond market with their fellow master race of currency dealers.
Well, actually, I think it's yet another front. It's a layer upon layer of this black propaganda being pushed on us by the banksters. But before I get to that, I want to show you this other headline here. IMF prepares to arm Italy with a bailout bazooka.
That's a beautiful headline. Bailout bazooka.
Again, that's just a headline. They know most people won't read past the headline, and that's the propaganda. But if you look into that article, Germany and France discuss fiscal integration. Germany and France may seek to implement stronger euro area governance by striking a deal with a core group of euro nations rather than seeking the go-ahead from all 27 members, it was reported. So again, this Überdebten from just Germany and France, though their banks are hardcore involved in financial fraud. They created a lot of these toxic fake derivatives that are blowing up around the world. They've devastated economies around the world, and now they're pretending that they're the Überdebten.
Yeah, and there's Sarkozy, the new Vichy government in France, basically kowtowing to the occupied German currency forces. There's Cameron in the UK appeasing the Überdebten currency blue-eyed devil with his happy talk to his constituency, similar to, remember, I believe it was Lord Chamberlain who made the same mistake leading up to World War II. So to follow down this path of currency wars, replacing shoot-'em-up wars with tanks and missiles, it's all being replaced with derivatives and money attacks. You see the same patterns emerging we saw 50, 60, 70 years ago.
Yes, and there's black propaganda, gray propaganda, and white propaganda is how it goes. And this fits in somewhere there. France vehemently denied reports that Sarkozy had agreed with Angela Merkel to equip the European Commission with new supranational powers. This is a statement from the Élysée Palace. The president has in no way the aim of giving supranational powers to the European Commission. We want to discuss the ways of creating more intrusive powers for Brussels to monitor countries such as Greece. So in the same exact sentence, they contradict themselves.
Beep, 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 beep. Sarkozy is lying. Beep, 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 beep. Sarkozy is now occupied by the Überdebten Munchen. Oop, beep, 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 beep. Please return to the base.
Obviously, the Élysée Palace is trying to assure people that the Überdebten people won't have any, outside authority governing them. It'll just be those dirty, stinking debtors down there, not the Überdebten debtors.
Right, the Petanque, the new unit of currency here in France, has no connection to the Bundesbank.
So, either the IMF is bailing out Italy or it's not. However, there is another rumor going around. Should the Fed save Europe from disaster? Nobel economist Myron Scholes was the first that floated this idea over lunch at the Reichsbank Forum in August. He said, I wonder whether Bernanke might not say that we believe in a harmonized world, that the Europeans are our friends, and we know that the ECB can't print money to buy bonds because the Germans won't let them, and since the ECB will soon run out of money, we will step in and start buying European government bonds for them. It is something to think about, he said. So Max, tell us who Myron Scholes is.
Well, of course, he's a big Nobel Prize winner for the Black-Scholes option pricing volatility formula. He is to derivatives what Einstein is to atomic weapons. He created the whole idea of splitting the dollar into two parts, reward and risk, and then trading risk separately, and then creating now 700 trillion in derivatives, which is pure risk, no equity. By the way, that number is up over the past half year to new record amounts. People thought that the derivatives market was shrinking. No, it's hit new all-time highs, along with the quantitative easing that's come. Thanks to good old Myron Scholes and his option pricing volatility formula, we can now look forward to having many more trillions of dollars worth of worthless paper, trading on worthless paper, which is nothing more than a huge Ponzi scheme, run out of Berlin, whose intentions are not to run Europe or run the world. Why would we ever think that of Berlin? They want to teach the world how to sing.
Well, Max, Jean has a long mustache. Grandma ate our bonbons. That was one of the sort of statements that Myron Scholes first came out with this, the Fed should save Europe. Now, let's look at the Fed and how they saved the financial system in America. Secret Fed loans gave banks undisclosed $13 billion. Well, this is information that has emerged from the Bloomberg Freedom of Information Act. And it turns out that the amount of money the central bank parceled out dwarfed the Treasury Department's better-known $700 billion Troubled Asset Relief Program, or TARP. add up guarantees and lending limits, and the Fed had committed $7.77 trillion as of March 2009 to rescuing the financial system, more than half the value of everything produced in the U.S. that year.
Hold on. Don't go away. I have to grab my prop bag. Is that exactly the same shot? More or less, within a thing? They committed massive accounting fraud. Hank Paulson, Tim Geithner. You know what it is? It's the old slinky school of economics. It's like, oh, here's $7 trillion, give us a loan. And then they get the loan, they go, oh, now it's over in the European banking system to help them fake out some kind of bailout package that they can't possibly afford. Oh, it's back in the U.S. now. Let's do a bailout in the U.S. because we have collateral now and the banks don't need to be bailed out anymore. We don't need a stress test. They've got, oh, wait, now it's in Europe again. No, now it's in South America. Now it's in Australia. Now it's on Pluto. Now it's on Mars. Now it's on some Paul Krugman spaceship in outer space looking for some aliens to bail out the United States due to some Keynesian theory that has been proved completely useless. Yes, it's the slinky school of economics. It never fails until one day we're all speaking German, which I'm Max Keiser, so, I'm prepared for that eventuality. Trust me.
Well, the loans were meant to deceive the public and the Congress, or at least it gave the Congress plausible deniability that they knew what was going on. The $7.7 trillion allowed the banks to transfer all their bad debts that would have indicated that they were insolvent to the Fed. And with that, Hank Paulson was able to go hold up the Congress. It was a big show for the population, however, because remember, at first Congress rejected it because of all their taxpayers calling them. And then the second time, the markets crashed and the taxpayer was the one saying, Congress, you better vote for this TARP. But in fact, the TARP never would have happened had they known that the banks were actually completely insolvent.
Yeah, and the key word there is insolvency versus illiquidity. Because during the time, remember, it was positioned as it's a liquidity crisis, it's not an insolvency crisis. Well, the reason it's not an insolvency crisis is because we're going to illegally park $7 trillion from one off-balance sheet item like a la Enron to some other off-balance sheet item. And we're going to point to that and say, you see, there's plenty of capital. We just need a little short term to get us over. Oh, by the way, when it's finished, we got to move it back over to some other place that we didn't tell you about before and it's completely illegal. So it is insolvency. And that's the root of this global crisis, is that these banks, BNP, Societe Generale, HSBC, Barclays, Citigroup, Bank of America, they are insolvent, okay? So you can write to me and you can come on my show and you can demonstrate why you're not insolvent, but you won't, because I'm accurately telling the truth here. You are freaking insolvent, and you need to go the way of all dust, ashes, and dirt, and everything that dies and ends up in the ground dead because you've got nothing on your balance sheet but lies. Stacy Herbert, thanks so much for being on the Keiser Report.
The baguettes are fresh and ren today.
Stay tuned, much more coming your way, so stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Venice, Florida, and speak with Carl Denninger of MarketTicker.org. Carl, welcome back to the Keiser Report.
Hey, Max, how you doing?
Very good. Carl Denninger, let's talk about MF Global. Why hasn't John Corzine been arrested or at least been pepper sprayed?
The least we could do is have a little pepper spray and maybe some plastic handcuffs. I don't understand this. The orderly functioning of the futures markets demands that customer funds be sacrosanct and never invaded. And that appears at this point to have not happened. It's one thing to say, I don't know where that $20 bill went, but when it starts as $600 million and then all of a sudden becomes $1 billion plus, you got to wonder, these guys not only can't find the money, they can't seem to figure out exactly how much is missing. That's a problem.
Well, it seems like a total breakdown of all of the basic laws of the street. This basic law, you can't take money out of customers' accounts. It's pretty basic. If this doesn't work, why would anyone keep their money in any of these brokerage firms?
That's the question, Max, I think that everyone has to be asking now. And it is the risk that, in my opinion, is the largest to the financial industry and to the orderly function of the markets that we've seen thus far. This goes far beyond what happened with Lehman Brothers and Bear Stearns, in that you now apparently have a futures merchant who got in trouble with their own proprietary bets, and instead of facing the fact that they were underwater and insolvent, decided to dip into customer funds as a way to try to cover them in the hopes that they come back. Now, anyone who's traded for any length of time has probably made this mistake where you get stuck in a bad position and you add to it because you're sure it's going to turn and everything's going to be okay. Well, anyone who's done that for any significant length of time knows what happens. You go broke. It appears that that's exactly what happened here, but then MF Global seems to have gone even further and said, we'll just kind of raid the piggy bank over here that isn't ours and keep the game going for a while. That's a deeply troubling thing, because if you have any kind of money on deposit with a brokerage, you have to wonder whether or not this is happening somewhere else.
All right, now my understanding is that JP Morgan is a creditor of MF Global, and they're going to push to get settled on any of their accounts that are owed money ahead of these customers. Isn't that also sending a bad message to the retail banking customer out there?
The real question, Max, is again whether there is or is not separation between customer funds that are on deposit as performance bonds. And let's remember, this is what the CME calls these. If you go over to their webpage and you look at the margin deposits that are required to trade contracts, they actually call them performance bonds. So if they are performance bonds, then they should be held separately. There should be an escrow function, and there is supposed to be a fiduciary responsibility. It's like depositing escrow money for a real estate transaction with an attorney. It's supposed to go into a segregated account. If that, in fact, has been violated here, and the evidence is certainly that it has, then essentially when you are trading with somebody and you are using them as a broker, you are, for all intents and purposes, backing their bets. And it doesn't matter whether it's a bank or a futures merchant. That's an insanely dangerous precedent to set within the marketplace.
I'm going to digress a little bit, because I don't know if you're familiar with this or not, but let me ask you this question anyway. The martingale system of betting, which is the doubling down on every roll of the dice with the idea that eventually you will win and make some money. This seems to be what every Wall Street firm is doing. They are continuously losing, but they are doubling down on every subsequent throw because they know that they've got unlimited cash in their disposal from the Fed. Is this sustainable? Is this a correct way to describe what's going on? Your thoughts?
I think it probably is. I'm familiar with that strategy. It bankrupts everybody who tries it eventually, because although the probability is that this will work out, the fact of the matter is that for any sort of random trial, each probability of success is distinct and separate from all that came before it. And so it is entirely possible to get heads 52 times in sequence and run out of money and go bankrupt. And that's the problem is that everyone says this is an infinite source of funds through the Federal Reserve, but in fact, there is no such thing as an infinite source of anything. And eventually you will run out of the ability to hide these games, and it will blow up in your face. And that is it appears, what happened here.
All right, here's another quick question. Federal Judge Rakoff recently in New York, he admitted that he had no authority to do anything but admonish the SEC for their settlements with Citigroup and Bank of America for a fraction of their ill-gotten gains on mortgage securities frauds. Your thought?
We need to see some prosecuting and much less looting. Rakoff is one of the good guys. He's at least out there raising an issue on this. But, Max, the real problem we have here is that there's this deadly embrace between the Federal Reserve, Wall Street, and Congress. Congress desperately wants to spend more than it takes in taxes because it is supporting the myth that the economy is okay, at least, and is not totally collapsing. You have the Wall Street banks that are anxious to earn their VIG so they can pay their bonuses. And then you have the Federal Reserve, which is the handmaiden and is enabling both of those things, along with the offshoring and the disastrous trade imbalance. And all three of these parties are kind of locked together, holding hands, saying la, 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 la. And what you end up with at the end of the day is selling a bunch of trash to people claiming that it's perfectly good paper. When it blows up in their face, then you end up in front of judges like Rakoff who say, hey, guess what, guys? You swindled people. And then there's a problem, because if you actually claw back the money that was stolen and impose a realistic punishment, and if you look at the statistics on these financial firms, you'll find that under our 3 strikes laws for felonies, essentially all of them would be in prison for life at this point, which means they'd all be dissolved and out of business. So why is it that we continue to give these people a pass while at the same time the common street criminal that robs Granny ends up locked up in a cell?
Well, I'm going to repeat that point, Carl Denninger, because I thought it was such a good point. 3 strikes, you get locked up for life, or the state, sometimes you end up on death row and kills you. Why don't we apply this to the crimes being committed in the financial space? And would it be appropriate to apply capital punishment in cases of outright fraud for guys like Hank Paulson, for example?
I don't know about capital punishment, but revoking corporate charters is certainly something that could be done. I mean, after the third offense, I think it's pretty clear that you're not going to reform, right? The only way that we're ever going to see this stop, Max, is if it stops being a business model. If you put a sign out that said robbing banks means that you only have to give back half of the loot if you get caught, there'd be a line out the door of guys with ski masks and guns. And so there's really no reason for these institutions not to engage in this behavior when that's the penalty.
All right, Carl Denninger, a Bloomberg Freedom of Information request has uncovered evidence that the Fed gave banks $7.7 trillion in loans, most of them in secret, in order to make the banks look healthy so that the Congress would give them those TARP funds going back to 2008. Your thoughts?
The biggest scandal there, Max, isn't that we gave this money out in terms of loans and guarantees. A lot of this was in terms of asset guarantees. In other words, allowing people to pledge collateral they otherwise couldn't. The big scandal here is the fact that every one of these institutions' CEOs seems to have shown up on CNBC or somewhere else proclaiming how strong and healthy their firm was, when in fact, if you look at this data, it says something entirely different. I thought we had this law called Sarbanes-Oxley. It apparently doesn't apply to people showing up on various mainstream media outlets proclaiming how wonderful they are. Well, their company is on the brink of collapse, a la Dick Fuld. But there needs to be some kind of enforcement mechanism here when you have firms that have their representatives showing up in the media to proclaim things that turn out to just plain old-fashioned be false. I don't understand how that's not something that you could sue over as an investor. But it appears that this falls into the idea that, we all have a First Amendment right to speak, and it doesn't really matter whether or not what we say has anything to, any resemblance to the truth.
Right. Now, of course, the banks earned $13 billion from processing these secret loans. Most of those earnings were then paid out as bonuses. So does the taxpayer have the right to reclaim at least that $13 billion that was fraudulently stolen from them?
Unfortunately, probably not. You could potentially, I suppose, file what's called a qui tam lawsuit, which is essentially suing in the place of the federal government for the fraud that has taken place. But in terms of the individual taxpayer having standing in these kinds of cases, it has been repeatedly held that they don't, even though it is the taxpayer that gets rooked. And again, this is just another example of the best Congress money can buy.
All right, I've got two more questions. IMF is either drawing up plans or not drawing up plans for another $800 billion rescue of Italy and Spain. If all its member nations are bankrupt, then where does the IMF get the money to rescue these bankrupt member nations, Carl Denninger?
They don't. So, I think it's a curious thing that they floated this rumor. It was somewhere $600 billion or $800 billion. I don't know where they think they're going to get the money from because it doesn't exist. They increased their special drawing rights allocations, of course. But the problem is that the IMF has to be funded by subscriptions from its member nations. And thus far, I think something like 2 or 4 of those nations have actually passed the allocations. The rest have not, including the big ones like the United States. So I don't know where they think they're going to get the money from. And I actually found the headline rather amusing. It was good for a big pop in the futures, but I don't see where the there is there.
Right. So you mentioned special drawing rights, and this appears to be going to be a kind of a new global currency in which to roll up all of this bad debt and reprice it, resecuritize it, create new maturities, and basically increase somehow the debt bubble to even new heights of absurdity. But finally, let's talk about the ending this never-ending bailout for banking and market rigging fraudsters. The CME Group, in their latest 10Q, listed Occupy Wall Street as a threat to their bottom line. So who's the bigger threat here, Carl Denninger, Occupy Wall Street or the bankers who their own fraudulent activities?
I don't know, to tell you the truth, Max. I think the problem with Occupy Wall Street today is that they are still trying to figure out exactly what they stand for. And I have pointed out, I'm on a couple of their mailing lists, and I've pointed out to them that if they get into the we want free blankety blank, I'll save you from the bleep, that they're going to end up being relegated to the dustbin of history because there is no such thing as a freebie. It has to come from somebody. On the other hand, if they stay focused like a laser beam on the fraud in the financial system, they have the potential to do what the Tea Party failed to do, and that is to get the public focused in its righteous anger on what's been done to them. I don't know which way this is going to go. On the other hand, you have the European banking system that is teetering on the edge of collapse. You have all of these institutions, including ones in America, that bought up all this debt in sovereign Europe, thinking that this was going to be some great investment because it was trading at a fabulous discount. The fact of the matter is it was trading at a fabulous discount because they can't possibly pay. So how you're going to resolve those two things, I'm not sure. But frankly, I see both of them ending very badly sometime next year.
All right, Carl Denninger, we're out of time. Thanks for being on the Keiser Report.
Thank you.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Carl Denninger of MarketTicker.org. You can follow Carl on Twitter at TickerGuy. You can follow us at Keiser Report on both Twitter and Facebook. You can send us an email at keiserreport@rttv.ru. Until next time, Max Keiser saying, bye, y'all.